All right, everybody, welcome into Mining Stock Daily. A little bit of a quieter day here on the podcast, but we are going to get some market commentary from private investor, Mr. Sultan Ameerali. He is also the author of the Consolidated Rock Holding Company Substack, where you can find all of his musings, what he's doing with his capital in this sector. Sultan, it's good to have you on. Listen, I literally... Fun story. I literally have been running around. We started summer break already with our kids. Nobody's in a routine. I spent all morning this morning driving my daughter around to various, things. I come back to my computer screen and all I see is a bunch of red. But I'm seeing like the S&P's down 0.6, Dow Jones down 0.8, but the charts look awful. Just absolutely terrible. And I don't know if it's just like one of the, well, I guess we'll find out, one of those healthy kind of pullbacks. We've been running hot in the markets for so long. There's continues maybe a little bit more concern about oil prices and energies maybe finally setting in. We are going to talk about how you are bulletproofing your own portfolio in mining, so with mining equities here. But really, let's talk about the big picture of things. Are you at all concerned about, is geopolitics, supply chains out of Hormuz, oil prices, is it finally starting to set in here?
Yeah, I'm of two minds of it, Trevor, right? So first off, thanks for having me back. But I'll put it to you two ways. On the one hand, oil market's telling us one thing, right? Very sophisticated, deep, broad market is telling us that this isn't a problem. Oil should be, intuitively, if you told us this fact pattern maybe in January, you would think oil was $180, right? On the other hand, we're all seeing the same sort of charts with the inventory numbers, SPR releases, inventories dropping down, that sort of thing. And so when I look at how Strait Hormuz and oil kind of affects my portfolio, in the short run, I see some volatility. In the long run, I don't see anything that's happening just because I've got a sort of a gold, copper focused sort of narrative. I think in the intermediate and long term, I don't see anything that's coming out of the Middle East that would be bad for, precious metal stocks in particular. But I could extend that out to things like fertilizer and that sort of thing, right? So I think that's a long answer to your question. The short answer to your question is, I guess it depends, right? So
Sure.
I would encourage people to maybe look at oil not so much as a nebulous sort of thing. I think the contract matters, right? And so, when you're talking about oil, you're talking about the grade and the contract, in terms of when it's going to be delivered, right? And so, an outlook for oil a year from now is different from an outlook for oil, 2 weeks from now, if that's when when we're talking about delivery. So, all of which is a long way of saying that, in the long run, I don't think this is bad for mining equities. I think it'll be a bumpy ride while we get there, but I don't think this is a bad thing for mining equities in the long run, for a host of different reasons.
Yeah. Are you starting to kind of look, or have you looked at maybe allocating capital, like maybe away from the precious metals, the base metal type of equities? Are you looking at industrials such as like phosphate plays? Are you, looking at fertilizer plays?
Yeah.
Anything kind of outside the commodity, the typical mining equity space, but full commodities? Have you allocated capital to any of that, or are you interested or looking?
Yeah. So when I'm thinking about, if we're talking about things that are sort of outside, like the industrial metals, Trevor is, or industrial sort of inputs, I've done it kind of two ways. So there are certain stocks that I've exited because they have exposure. For example, the laterite nickel requires sulfuric acid, right? And so I had exposure through a company called Nickel 28, and just sort of seeing where the world is. Nickel 28, their Ramu deposit is, it's a JV. It's in Papua New Guinea. All the sulfuric acid for that is coming from a part of the world that is currently blockaded. So and also looking at the fact pattern, the last time around when nickel 28 ran into high sulfuric acid prices, it really impacted margins, right? And that makes sense because of what we know about how laterite nickel works. So on the one, so selling and sort of reducing my exposure to those byproduct commodities that come out of the Middle East was phase one. Phase two is a bit more interesting in terms of, uh, phosphate would be interesting. I actually was thinking about things in terms of less about food production and more that high quality phosphate that you would go into an LFP
Mhm.
battery, the lithium phosphate iron battery. So, um, I haven't allocated any capital that way yet. But I am looking, and uh, you know, I think for me, getting a better sense of what the actual long-term impact is going to be, right? And I think
Yeah.
you know I'm not a person who's going to allocate capital based on geopolitics or macro. I think there's a lot of people who are going to kind of give you some high level macro thesis or whatever. I think as a retail investor, person who investing my own capital, my job is to bulletproof the portfolio as best I can. I guess we're not going to know until 6 months from now how well I've done, but what I mean by that is your portfolio should be stress tested so that no matter what outcome, you should be coming out the other side, with a positive number, right? And so,
Hmm.
a portfolio that's built to handle a variety of outcomes, including oil at $180, including oil going back to $50, and anything in between.
Yeah. Let me ask you on the copper side. It made me think. You said you exited the nickel position because of
Yeah.
lack of availability of its inputs, sulfuric acid. Once again, selfishly, I would go back and highlight an interview Chris Berry from our Power Current podcast did on the ClearCom network on sulfuric acid. This was about 2 months ago. It was a great, great conversation he had about that. So I highlight going back into that. But the sulfuric acid is also a major input for copper
Yes.
producers, right?
Yes.
And we have seen copper, the supply alone, there's been a lot, it's been bid up. In fact, we we tapped those all-time highs just
Yeah.
yesterday,
Yeah.
and we're seeing that pullback today. But I'm wrestling with my thoughts here. Like, obviously, if we have sulfuric acid supply restraints, we're going to have supply restraints on copper going forward. But does that mean that the producers are going to have a harder time? And does it get hit? Do those copper producing equities get hit because of it? Similar ways that we've seen, it's like Mosaic, the fertilizer equities got hit
Mm,
about a month ago
yeah.
because they didn't have enough sulfuric acid for their input for fertilizer, and they
Yeah.
just got pummeled.
It's an interesting question, right? Because when I think about uh, sulfuric acid in particular and sort of copper, when we're talking about nickel, like that's sort of one thing, right? Because you've got your nickel sulfides, and in theory, the nickel market is pretty well supplied, right? And so, you can cut capacity in Indonesia, price goes up. There are some levers you can pull. I don't know how you pull those levers with copper, right? Like, it's not like you can, um, take copper out of the market in order to, it's already at an all-time high, right? And in some ways, every trade is an AI trade, and in particular with copper, just industrialization and sort of build out. And so um, when I look at copper, I don't have any copper producers in the portfolio currently. So my main exposure to copper is through Surge, which is the Berg deposit in BC. But it's just that it's a deposit, right, Trevor? So it's
Right.
that idea of that input isn't necessarily required at this moment. And again, well sort of funded. I think in that position, I'm again, and as part of that bulletproofing of the portfolio, um, it's not required as an input into any stocks that I'm owning right now. But in theory, that rising price is a beneficiary. I mean, Surges has a PFS that's coming out. literally any day now, right at the end of the second quarter.
Hmm.
So, uh, you start inputting $6, $7 copper into some of those numbers, and you get some very interesting valuations on something like that. So,
Yeah.
personally, it's you're right, and the other thing I would highlight here is there just isn't enough copper. I'm sure in your conversations you're hearing the same thing. Like these smelters, like the place, they're taking the inputs for free, right? Just because they need supply to run through, right? So there's a definite shortage there, and this isn't a situation where I think the price is gonna drop down anytime soon.
Yeah. What about your gold positions? Are you still feeling relatively comfortable despite the volatility in the macro and the geopolitics? Are you still feeling pretty confident with your gold positions?
100% boring is good. And so, uh, if you think about I mean, I guess like yeah, sure, we're a little bit flat, but you think about where we've come from in the last 18 months, right? Like this is a very healthy sort of basing out period, probably before it keeps going higher. And I'm not going to point to charts or anything. I'm just, if we just look at the facts around uh, war is very expensive. It's a very expensive business.
Mhm.
We we have an incoming Fed chair. I don't know what he's going to do, but I wouldn't want to be him, right? Like uh,
Right.
you can't raise rates. That would make the deficit unsustainable. You can't really lower it. Everything's so I think his only course of action is to um, either run it hot the way Trump wants to, or to keep it where it is. Either one is a good position for gold to be in. Now you start to layer in the geopolitics of de-dollarization and people quite frankly not wanting US treasuries, right? And that's this thing that's sort of hanging out in the background. You've got a 10 and a 30-year at all-time highs in terms of yields. Uh, it's not a good place to be, right? Like you either have to devalue your currency, which is happening in slow motion, or uh, you know, uh, and if you don't do that, it's austerity. I've never nobody willingly picks austerity, right? And so uh, I don't see a bad outcome out of all of this for gold. I'd be shocked,
Yeah.
even if you look at the short term things like Turkey selling gold holdings, that was because there were bills to pay, which tells me actually that gold works as a reserve asset. And
Yeah.
I remember, I think you tweeted something this week, Trevor, around central bank buying and you know gold surpassing treasuries. And if it wasn't,
Gold has overtaken treasuries for the
yeah,
in amount is more reserves under gold than US treasuries.
yeah, and so that's an interesting sort of data point because I don't see that stopping. Do you? Like, it's not like they've okay, well, we kind of hit our allocation. I think it keeps going.
Yeah. So I am, and I've been kind of wrestling with kind of my own internal roadmap for gold
Yeah.
for the rest of the year, given everything, the headlines that we're watching right now, and obviously the moves in the stock market. Like, I'm very much concerned that some of these big name AI space IPOs will be sucking a lot of equity
Yes.
out of funds and into something that's completely outrageously overvalued. However, so my roadmap here, and this is the way I'm thinking of things, Sultan, and feel free to chime in here, but I do not see the conflict in Hormuz de-escalating. In fact, I see it escalating.
Amen.
Um, maybe not to wartime scenario, but escalating to the point where oil prices, energy prices will go higher and probably will so in the next month or two.
Yeah.
With that, there will be a political backlash. There will be destruction demand. There will be a I think a recession is knocking because demand will be
Yeah.
destroyed. But that recession will provide Fed Chair Warsh and President Trump the ammunition to cut rates and probably cut rates aggressively. I think
Yeah.
they have, you know, the argument has been they haven't been able to do this because there hasn't been the reason to do it. Right now we have inflationary pressures, but if we have a
Yeah.
supply-driven recession, they and demand cracks because of it, they will have the ammunition to cut, and they will do so aggressively because President Trump, he likes to go big,
Yeah.
but that will be the turn in precious metals. So I think somewhere around the end of Q3 into the winter, like gold looks pretty dang good. Like 2026, we could look back and be like, you know, $4,500 an ounce will be an afterthought.
When I see, I'll position it this way. It's, if I'm the Iranians, I don't really have anything to lose at this point, right? Every time you go to the negotiating table, somebody's lobbed a missile and killed one of your leaders or something like that. And so,
Right.
the idea, and the other thing I've learned over the years is, and this goes back to before Trump was president. It's, uh, you think you have the answers, and then the man changes the questions, right? Like he's nothing if not predictable in terms of how he goes about being unpredictable. So, um, what do we know? We know that it's a situation where I don't think you can negotiate a lasting peace in a way that is going to make everybody happy, right? That's clearly impossible.
Right.
So, what's the deal that everybody can live with? And to your point, if there's with a bunch of hardliners now in charge because everybody at the in Iran, um, if there's no deal to be had and it's and you start pushing in. Iran really doesn't have anything to lose by just sort of lobbing missiles, either through proxies or at infrastructure, at
Mhm.
things like that. And to your point, the price of oil could go up because there's a force majeure situation where everything kind of blows up. When it comes to a recession, yeah, obviously there's ripple effects from that. I would tend to agree in the sense that correlations go to 1 in a market meltdown and in a recession, but I think in the longer run, it's particularly with the precious metal, um, it's gonna be a rare opportunity to kind of jump back into a trade that's moved a lot. I mean, if you think about where we came from
That's
with
true.
gold, to where we are now, uh, but it's the only commodity market that I can think of, and it's not really a commodity, to be honest. It's a monetary metal. Like, the supply demand is insatiable, right? Like it's, it may go down in the long run because people need liquidity to pay for things. But as far as a store of value goes, nothing's going to beat it. And so, it's not like we're going to dump a bunch of gold on the market and it's going to satiate the demand, right? It's,
Oh, be
uh,
careful. We're going to audit Fort Knox. That's what we're saying.
yeah,
We
and
brought
so,
that back on the
uh,
table.
yeah, we're back on that apparently. So, I, when I look at gold, I don't think it's a matter of, Trevor, of, gold's gonna, it's how far it's gonna move in the long run, and
Mhm.
how do you get the most leverage to the trade without taking on a lot of risk, right? And so, um, the way I've chosen to do that is, uh, you know, something like I Am Gold, where you've got the whole camp, and so
Yeah.
I could that whole Shibugamu camp, and you have Kote, so you've got a tier 1 deposit and the entire camp. What we saw from Agnico is, if you're a major and you can just buy into the camp completely, you can do that. So that's great. So that's one way I've chosen to do it. Um, Another is a company called Banyan, which I know you're familiar with, Tara Christie, and what they're doing in the
Yeah, very
Yukon.
well.
But again, that would be another camp, right? You could pick any number that it's, whether it's Banyan or White Gold or, Coffee Forte, right? Like, pick your flavor, right? And um, that idea of, imminent production, at some point it'll be a mine. It's just a matter of how much, they're willing to sell for. I think the third piece of that is, uh, you know, these sort of long life royalty names where maybe the short term volatility that comes from people lobbing missiles, potentially a recession, might give you a good entry point into some of these names, right?
Mhm.
Because when correlations go to 1, um, the ability to write a big check and to maybe look 18 to 24 months out is a superpower, right? And it's not like you're not taking any risk when markets drop like that, but the risk you're taking is that by providing liquidity to somebody who needs it, you're getting a discount on the price, right? Essentially what we're talking about here. And so, um, uh, that's something that I'd like to be ready for. And it's part of the reason I'm not necessarily deploying capital right now, because I don't disagree with anything you're saying in terms of a sudden shock to the market or a recession or something that would take equity prices in general down in the short term. What I would say is when we're talking about the AI trade, almost, outside of Hormuz, every trade is an AI trade in some ways, right? Like when we're talking about industrial metals, um, whether it's lithium that goes into batteries, we're talking about best storage, we're talking about copper and electrification, cheap electrons, we're talking about uranium. All of those trades are AI trades, and you know, that narrative around um, capex and whatever, I would caution people. Um, the tendency sometimes is the bearish take sounds smart, right? And sometimes the simplest answer is the correct answer. I'm not saying there won't be a build out and a bubble at some point, but if you look at your life, I'll just throw it out to you, Trevor. How much AI are you using now in comparison to a year ago, right?
A
And how
lot.
much AI are,
A lot.
yeah, right? And how much AI are you going to be using in 5 years from now compared to net today, right?
Probably more.
And
Yeah.
what's the Yeah, probably more. And what's the constraint that these companies that are using AI are facing? It's tokens, right? If they could make their
Yeah.
service unlimited, they would, right? They just can't because the constraint is electrons. And electrons, that capacity to build data centers. Um, so when you look at it that way, this isn't pets.com, right? That was an internet that wasn't quite ready for prime time, right? If you think about what the tech bubble was, that was pre-YouTube, pre-ubiquitous video streaming. We were still using broadband cable and dial-up internet, right? This is um, a separate thing where uh, and every time people are coming up with AI use cases, right? Like new use cases every day. And if there's a recession, Trevor, it's not going to stop me from using ChatGPT to look something up because it's just simpler than trying to go and find it, right? It's probably not going to stop a developer from using Claude. Um, and so, uh, I'm not saying caution isn't warranted, but I don't think you want to apply that to the AI build out universally, right? And so if you can get down to first principles on that, then when we talk about things like copper, you can kind of see what the road looks like. I don't think copper gets impacted, in the long run by an AI build out. Now, if you're buying a data center name like Iron Energy or something, it might be a different case, right? And that's outside of the purview of a show called Mining Stock Daily, so we'll put that aside for a moment. But I think for, uh, but when we're talking about lithium, when we're talking about silver, when we're talking about um, copper, and then other names that I don't necessarily trade in, the more rare earth metals and the things that are more niche. Um, you know, I, I think of those a bit differently, I think, than most people, right? SaaS names, absolutely. Be skeptical. Not every software company is going to survive. When we're talking about the nuts and bolts of a build out, when the capacity constraints are tokens, ideally we get to a world in 5 years where tokens are a non-issue, right? Like the energy should be ubiquitous, the capacity should be ubiquitous, and we can just sort of soak it up. We're not there yet. The tech bubble that everyone talks about in the 90s, that was building out the fiber that the modern internet was based on. And we built the fiber before the capacity came in. In this case, we're hitting capacity. I think a much different thing. So I would encourage people to kind of look past that narrative and kind of dig deeper. And when you dig deeper, I don't see a bear case for commodities. Like if there was a periodic table ETF, I'd buy that, right? Get myself some Scandia, and so, yeah.
Yeah, there you go. One-stop shop for all things.
Yeah.
All right. Hey, great thoughts. Great thoughts, Sultan. Thanks for sharing. And I think I'm going to go back and actually listen to what you just said because it kind of made me think a little bit and challenge my own thinking. But I appreciate your time. Thanks for connecting with us here, and keep writing. Best of luck. We'll talk to you again here probably, I don't know, next month or so, and see how things are playing out and see how these equities and these resource markets are behaving.
All right. Sounds good. Thanks, Trevor.
All right. Thank you, Sultan. All right, everybody. That's Sultan Ameerali. You can find him over on X with Sultan Ameerali, SultanAmeerali. Must follow if you're in this space. All right. We'll be back with more for Mining Stock Daily. Stay tuned.
The information presented should not be considered investment advice. Mining Stock Daily and its affiliates are not responsible for any loss arising from any investment decision in connection with the material presented herein. Please do your own research or speak with a licensed financial representative before making any investment decisions.